Hi, I'm David Giles, the property guy. Today I'm going to be talking about the Bank of England interest rate rise. So the Bank of England, this is pretty big news, have raised the interest rates by 0.25% from 0.25% to 0.5%. Now this is the first interest rate rise in 10 years. So obviously back when we had the 2008 recession, interest rates went sort of down from 5% to 0.5% because the market was struggling. So interest rates had to come down. But if you can remember when Brexit happened, that's when they went from 0.5% down to 0.25%, which was only about a year ago. So we're only going up 0.25% from where we were a year ago. So it's not a huge deal. But what I find really interesting is actually a lot of people get scared when interest rates look like they're going up. But when you actually think about it, the reason why interest rates do go up is normally because they need to cool the market. The market's going too crazy. You know, and where we are, where I am positioned, which is Bournemouth and Poole, that is my property investment arena for my own ventures and on behalf of my clients at Embark. It's been a very buoyant market, you know, so 0.25% isn't something that should affect any sophisticated buy-to-let investor, some landlords, property businesses, their portfolios. They should be able to weather 0.25% if they've built their portfolio correctly. But what my feeling is that this 0.25% rise is just taking the foot off the gas a little bit, as opposed to anything you should be, you know, really, really worried about. There is talk that over the next 2 or 3 years, the base rate could be as much as 1%, which would be another 0.5% rise on what it is today. But that typically means that it's a positive thing for the property market, because if they're trying to make borrowing more expensive, it means there's a lot of demand in the market. So it must mean there's being some capital growth. So as long as you can weather the storm of higher interest rates, then there should be the reward of higher property values at the end of it. I mean, I guess one of the key things to understand is why interest rates go up and down. And the reason is because inflation is the devaluation of money over time. And because the general consensus is that inflation is going to rise, they're feeling that they just need to put the brakes on it a bit, just steady that a bit. But in terms of the global economy, where the UK sits at the moment, it's not performing quite as high as it typically would be, but that's because we still have this uncertain times for not just in property, but you know, in business as well. So who does it affect? Who does this interest rate rise affect today? Well, I guess if you're on on your standard variable rate or a tracker mortgage with your buy-to-let portfolio, then you're going to see, you know, a small increase. It's going to slightly costing you slightly more a month on those mortgage payments. If you're in a fixed term mortgage, you know, a 1, 2, 3, 4, 5, 10-year fixed, some products out there, then you're not going to see any difference until you come off that fixed term period, and whatever the base rate or lender's reflection of that base rate in terms of the products available, that's when you'll start to understand what your mortgage payments will be. And I guess this is why I always stress the importance of having a really good mixed blend but high performing property portfolio in terms of income, because cash flow is king. In my opinion, capital growth is absolutely fantastic, and you know, it does form part of my own personal property investment plan over the next 10, 15, 20, 25 years. And when I'm talking to my clients at Embark, we're sort of foreseeing how their portfolios look today, if they've got, say, 10 properties, but it may be that we're relying on 10 or 15% capital growth over the next, you know, 10 to 15 years, whereby we could sell half the portfolio and they might have 5 properties left, and that capital growth should downpay the remaining mortgage balances. So guys, I guess what I'm saying is don't stress out about this 0.25% interest rate rise, or another quarter or 0.5% that may be coming in the next 2 or 3 years, because what you need to focus on is how you can make your property portfolio yield higher than what you expect the interest rate could be. So if, for example, your thoughts are that interest rates could go to 6%, not the base rate, but the base rate combined with your mortgage lender's rate, if it could go to 6% collectively, what does your rental portfolio net at? Is it 4%, 5%, 6%? So whatever you think or want to assume that those rates could be, and what level you're going to need to service debt at potentially in the future, well, you need to be focusing on your rental portfolio and making sure that the buying decisions you make and how you structure them and the strategies that you implement and how you leverage them or how much you leverage them will be able to weather that assumed rate. And if you do that, then there's really not a lot to worry about. If you're so really scared about mortgages and mortgage interest rate and the Bank of England put the rates up, and you have the ability not to have to use mortgages, then don't. Just buy properties with cash. I guess the negative on that is you're not leveraging, so you're not going to make the most of your money. So those cash yield is what you see when you see estate agents' adverts. They're typically in the remit of 4%, 5%, 6% yields, but that's gross yields and that's based on a cash purchase. But when you leverage with mortgages, whether it's at 50%, 60%, 75% seems to be the sweet spot. When you do that, you're getting leverage yields of 10, 15, 20%. So by not leveraging, it could cost you, but it's obviously a lot safer just to use your own money. But that's your decision. But guys, if you want to know anything more about this, then always pick up the phone. You can call the office on 01202 930 930, or you can drop us an email. You'll see that come on the bottom of the screen shortly. And if you're interested in keeping up and abreast with the local property market, I write and publish the Property Investor News specifically to Bournemouth and Poole, and you'll find all sorts of information about the local property market, what's happening, what's the best type of properties to invest in and why, and how things like interest rates are affecting our local market here. So if you want to know anything about that, on the bottom of the screen you'll see the address to the blog where you can click on there and you can subscribe. It's totally free, and every time I write a new blog or article I'll send that off to you. And if you want to discuss it, please get in contact. Well, I've been David Giles, the Property Guy. It's been a pleasure reporting to you today on the Bank of England recent interest rate rise. I'll see you all again soon.